El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. La emisión está comenzando. Todos los asistentes están en modo de solo escucha.
I'm Andrew Wilkinson with Interactive Brokers. I am joined today by Kevin Davitt over in Chicago. Welcome back, Kevin. How are you?
Andrew, I'm doing really well. Thank you for having me back. Happy St. Patrick's Day, even to the Brits. Glad to be here.
Kevin is head of index options content over at the NASDAQ, and it's always a pleasure to get him on the line. Kevin, how is the market treating you?
I'm going to talk a bit about that. Like when you asked me from an exchange perspective and also from a brokerage perspective, volumes tend to swell when volatility picks up. And in that business vacuum, it tends to be good. But I want to be abundantly clear that from like a bigger picture investor standpoint, that I don't take 10+% drawdowns in the market lightly. Do I think that there are increased use cases for optionality in that environment? Potentially. And so I just want to be delicate, because every time this happens, and it's something I'll touch on in a couple of minutes, the reaction tends to be swift. There are elements about this one that feel unusual, but generally, in a grand scheme of things, this is normal within the scope of any calendar year. Does that mean this one will look like some previous drawdown that ended right at 10%? Who knows? But overall, I want to be tactful about that. This could continue, and we'll talk a bit about how it could be like 2022, which was nastier, or something more benign. So generally good. I think maintaining perspective against this backdrop is difficult, but super important.
I don't know about you, but I felt that this drawdown was somewhat orderly.
I totally agree with you there, that we have not seen, despite a day where the NASDAQ 100 was down essentially 4%, and the S&P is right around 3, which in other situations might have been accompanied by what you might classically call capitulation moves. I don't think, just based on my experience, that we saw a day or behavior like that thus far. I'll draw some analogies to July through August of last year, where on the 5th we had that yen story and a capitulation-like move. We haven't seen that. Does that mean we have to? No, but I agree with you on the orderly side of things.
Yeah, it's.
I suppose that's good. I don't know.
It kind of smacks of not being over yet. I mean, what about the ascent of volatility? Again, that was just incremental, and did we hit 30 on the VIX?
Like maybe for a second on that one day. It hasn't been. And again, there are so many indicators from a sentiment perspective, from flows like into Europe, all sorts of other things have shown these huge moves over the past handful of weeks. From the lens of index derivatives, there's been less of that washout. And maybe that's just the maturation of the market or enough participants being hedged, following 2 really good years for broad markets. I don't know, but I share your sort of observation that we haven't seen some of those classic signs of, oh man, like the weak hands, for lack of a better term, got flushed, and now we can kind of find our footing. What could become that point potentially is that we have a quarterly expiration this week, which you're well aware of, and your listeners likely are too. And the gamma exposure, the move that we've seen more recently, has pushed dealers, liquidity providers in the index world towards short gamma positions. Generally, that exacerbates daily movement, and perhaps that abates when this exposure rolls off or is pushed out in time, typically to the next quarterly, so June.
Right. Yeah, I just feel that the economy has got some suffering to do that's not currently priced in. And as those numbers start to roll out, I've just got a feeling we haven't seen the end of this at this point. But I think we could talk about that on another podcast. And talking of podcasts, Kevin, I really enjoyed my conversation with you last week with Nick Smith, who was visiting from Miami up to Times Square here. And that episode is just about to drop on the IBKR campus. So you heard it here first, folks. There's a podcast coming out in the next few minutes featuring an interview with Kevin and Nick Smith at the NASDAQ. And I think we're calling it No Guts, No Glories, Only Volatility, Kevin.
I'm excited to listen back, and I rarely feel that way. I find it difficult to listen, but sometimes it helps to refine approaches or the way things are explained. But I think it's going to be an interesting compendium. And honestly, the catalyst for the handful of things that I have written and spoken about recently was a previous Interactive Brokers webinar, a really salient question that just introduced this idea, and it's awesome how these sorts of engagements can mushroom. So thank you, and thank you to the broader Interactive Brokers audience for just asking great questions.
Brilliant. So if you receive the Traders Insight newsletter every day in your inbox, this podcast hopefully will be at the top of it, or you can visit us under the education menu at ibkr.com. Okay, Kevin, you're going to talk about US large cap equity exposure and the impact on volatility today, are you not?
I am. I mean, that sounds quite dry. But volatility is the word of the day, the word of the week and the month. And so it will pair nicely with that, with the podcast that will come out. And I also want to comment briefly on the sort of backdrop now, but thinking about how shifts in relative volatility can impact sort of longer term out and underperformance on the part of different indices is something that I find interesting, and perhaps a number of the listeners will as well.
Brilliant. Okay. Before we get into it, let me just do a little bit of housekeeping, if you wouldn't mind going on to the disclosure slide from Interactive Brokers, which we always put up at the beginning of all of our events for the audience to review in the event that we're talking about risky products, asset classes, and so on. Please do take a moment to read that. The handouts for today's section are available in the GoToWebinar panel. Expand the handouts section and you'll be able to click on the link to the PDF. You'll receive a recording link about 2 hours after Kevin's wrapped up here at probably about 1 o'clock Eastern time. Are we Eastern Standard Time now or Eastern Daylight Time? I never remember, but anyway, a couple of hours from now. Use the chat panel to engage with Kevin. I'm going to make Kevin an organizer. You might lose audio for 1 second, Kevin, just bear with me. And you use the chat panel to input any questions for Kevin, and we'll do a Q&A towards the end. And anything else? I think that's about it. So Kevin, please take it away.
Thank you. Let me move forward. We already talked about generally who I am and what we're going to talk about. And as Andrew mentioned, there's risk in every market at all points in time. Listeners are well aware of that. Excuse me. And Interactive Brokers, I think, does an amazing job of educating their user base on the risks associated with derivatives. So just one quick point on that and a plug. I spoke with a longtime friend that was like, I'm thinking about opening a taxable account and doing some of the things you talk about. Pointed them to Interactive Brokers and saw all the risks, sort of disclosures and the tests that you have to take. So thumbs up on that. I'm a firm believer that those that think very much front and center about the risk in any given market tend to do the best over the long time frame. And on that long time frame point, this arguably kind of brings me to this visual. And here is me going back to that bigger picture point about perspective. It can be really difficult to maintain perspective when you see an account lose 10% or more of its value in short order. That is never, ever fun. And I know that from plenty of experience. But it's also part of navigating capital markets with longer term goals in mind. And those I think about capital protection, preservation, and growth. I am not making light of the current sell-off. Drawdowns stink every time. Every one of these stunk. But it is part of being in this business. This is a look at the past 10 years of drawdowns in the NASDAQ 100. That is reflected in aqua green, and the S&P 500 in what I'm going to call light brown. Markets are not typically at all-time highs, and sometimes they are well below those levels, but generally over long time frames, they trend higher. Also something that the audience likely knows, but it's important to point out during periods like these. You can see that both indices have moved to or through this red horizontal correction line. This, for compliance purposes and planning purposes, was taken a little over a week ago, right before the S&Ps did close down or tick down 10% at one point. I think the intraday lows in the NASDAQ 100 were down like 13.5%. We're slightly off those lows now and moving a little bit higher before I logged on here today. But when you look, the bigger point is that the 10% drawdowns happen with very significant frequency, and many of them do not end up in real bear market corrections. Now you could call your attention to 2018, where the S&Ps didn't quite go into a bear market, and NDX was there for what feels like, I don't know, a New York minute, but it wasn't fun. And then 2020, it's ironic on these dates because essentially the middle of the third week of March in 2020 was the inflection point. but it was the fastest equity decline of 20% ever. I believe, depending on which reference asset you're looking at, this current one is either the 5th or 7th fastest 10% drawdown. And I really think that's the element of this that is most off-putting, not necessarily the drawdown, but the velocity of it. So we'll talk about some of those points. What I'm concerned about, what Andrew and I were speaking a bit about previously was, is this a 2022-like environment, which was a different beast? From my very personal perspective, it's what I hope that we're able to avoid this year. 2022, as many listeners likely know, was a lengthy, painful drawdown with some vicious bear market rallies. It wasn't fun, and even like tactical hedging was difficult against that backdrop. You likely know that tech stocks got pummeled. That's been the case over the past couple of weeks. Consumer discretionary as well in the heap pile in this most current sell-off. And like I mentioned, the speed of this is sort of what's put a number of people on tilt, and that's been the scariest thing in my opinion. So you can see that 10% drawdowns aren't all that unusual, but occurring over a 2.5 or 3 week period makes it potentially scarier. And I don't know how this will resolve, but what's happened so far is normal in the grand scheme of things, and I think it's important to remind ourselves of that from time to time. Now, going back, well, we've moved on visually, and I want to talk about what you're looking at now visually, but this speaks to the point about the speed of the move we are in the midst of. It's a look at 10-day realized volatility on a closing basis for the NASDAQ 100. And this goes back to 2023. I'll talk a bit about what that looked like in 2022. But as you can see, for the better part of the past 2 years, what I'm going to call short-term realized vol has mostly chopped between 25% and like 12% on the low ends. 25% relatively high, 12% relatively low. But to be clear, for lengthy stretches in 2022, short-term realized vol remained above 25% in the NDX. So if we have a rerun, some sort of similar dynamic this year, it wouldn't be unrealistic to think that realized vol can stay around these levels. So far, my primary point of comparison in this experience of the last couple of weeks is it's reminiscent in a number of ways of the mid-July to early August period of last year. Now, on August 5th, people pointed to the yen carry trade unwind, but the market had been declining for 3 weeks coming into that Monday in August. And then we had what is very easy to say in hindsight, but a capitulation day. If you compare the peak to trough drawdown so far and the shift in short-term realized vol, as well as where 1 month implied, so options-based volatility moved to, this move seems quite reminiscent to that period from like 9 months ago. Who knows if it will resolve like that? Only time will tell. The thing that perhaps makes this unique so far is that the selling, and Andrew and I spoke about this briefly before we went live, has remained very orderly by modern market standards, in my opinion. I think Andrew shares that opinion. There has not been a classic capitulation move, but to be abundantly clear, that's not necessary to have a drawdown reverse. So let's move from kind of the gyrations of the past few weeks to a much broader look at volatility through a couple of lenses, my broader focus here. So I do monthly presentations with Interactive Brokers. At the end, I try to leave time for questions. And last month, I got an awesome question that essentially is what kickstarted this deeper dive into what I believe is some really interesting relationship measures, which we'll cover, which Nick and I spoke a bit about in the podcast. And I'm going to paraphrase the question that was asked in that webinar. You see it up here on the screen. Something along the lines of, given the maturation in technology writ large, like now they're highly profitable, and the shift in S&P constituency, it's become more heavily skewed towards technology as well. Could you see some scenario where the NASDAQ 100 index, we abbreviated NDX, realized or implied vol is at a discount to the S&P 500 volatility measures? That kicked off a whole lot of thinking. And the fact, like, what I pointed to in the moment, unprepared for that, was like the fact that the constituency makeup differs in a number of ways. We'll talk a bit more about that. But the key one that popped to my mind was the fact that the NASDAQ 100 excludes financials, things like banks, insurance companies, and the like. So keep that in mind as we continue. And now we'll take a broader scope about this sort of issue and the index investment landscape. So my point here, and I come at this, or I bump into this all the time. Sophisticated market participants understand differences between indices. But there are a huge number of people that kind of think the numbers that show up on Bloomberg or CNBC or whatever your financial outlet is, or wherever you find it online, like they're essentially all the same. And that there's like no real distinction. And I try to highlight the number of ways where that's not the case. Now, you know that U.S. equity markets tend to move in the same direction, but they move with different velocities, and there are a handful of reasons behind that, which we'll talk about. And I consider myself a NASDAQ 100 NDX advocate, so that's kind of how I look at it. Now, thinking longer term, I thought this visual from Statista, they put out some amazing data and data visualization, broad landscape view. The visual on the right-hand side shows the average lifespan, or the time spent in the index, for the S&P 500 for constituents going back to the original S&P 500 in like the mid-60s. Excuse me. Now, the far right side of this visual is forward-looking, because you can see like 2027 and 2029, where perhaps that hooks a little bit higher. But the S&P of what I'll call old stocks tended to spend a lot more time in the index. So I'm going to distinguish that. And I'm sorry for drinking during this, but I've been coughing a bit lately. I'm trying to keep that down. From like 1965 to the mid to late 90s, the average S&P constituent spent somewhere in the ballpark of 25 to 30 or more years in the index, and then something changed. Obviously, the markets changed in 1999 and 2000 for anybody that's at least as old as me. Something changed kind of in this 21st century. The index turnover has become much more rapid. The average lifespan of S&P company has fallen dramatically. Over the past 25 years, the average lifespan is somewhere in the neighborhood of 20 years or a little bit less. It is down very significantly. My takeaway there, and again, mine, an opinion, is that change is kind of generally occurring more quickly. Nothing, they're not going to give me a TED Talks for saying that. But what are the other implications there? That's sort of what's been eating at me. Over longer time horizons, though, when you think about indexing, and as somebody that works for NASDAQ, a big indexing group, I most certainly do, you know that winners tend to stay in an index and losers get relegated, to use a term that Andrew would for probably his favorite football team. On a related note, over long time frames, index returns generally come from a relatively small cohort of constituents. Now, the concentrated returns that we've seen over the better part of like the past 2 years have been fewer names than normal, and the gains in many cases have been larger than normal. So that is one of the risks that's kind of being addressed as far as where the selling has been localized. But that's the thing about averages. I think we can conflate an average with normal, and we rarely have just a normal market. If somebody could tell me what a normal market is, I tip my cap, because change is the constant. And what's happened over the last couple of years is that the S&Ps have come to look more like the NASDAQ 100, arguably plus like 400 names, including financials. My read here would be that there's more turnover in the S&Ps because the laggards keep lagging. That's part of the reason that the NASDAQ 100 has outperformed the S&Ps in 13 of the last 16 calendar years. Now, this was essentially, I've switched my visual. This was essentially what catalyzed this conversation with my colleague Nick, with Andrew, about volatility. And again, you'll notice that this is a fairly substantial time frame, going from the crisis period, the global financial crisis, up to very current modern day. This visual keeps sort of looping in my head, and I want you to understand what we're looking at, and I'm open to interpretation. The light blue line shows the difference in rolling 1-year price returns between the NASDAQ 100 and the S&P 500. On that point, I would highlight 3 periods of very significant outperformance. This is like 2009-ish. This is 2020 COVID outperformance, and this is 2022, okay? Outperformance on the part of the NASDAQ 100. And then underperformance here. So we're talking about like 2013, and then before that rebound in 2022. Now, the yellow line denotes like break even on a 1-year basis, and that's essentially where we are right now. If you look back over a 1-year time frame, returns for the NASDAQ 100 and the S&P 500 are essentially even. So we're at that break-even line. One other little tidbit for Andrew and other European listeners is that for the first time, and I can't figure out exactly when yet, but hopefully I will, the Euro stocks are outperforming both the NASDAQ 100 and the S&P 500 on a 1-year rolling basis. You've probably read a lot about that recently. Whether that continues will be interesting. Okay, now, the purple line. So it's a much narrower squiggle here, for lack of a better term. The purple line plots the rolling difference in realized volatility between the two indices. Now, you'll observe that that line is almost always above that 0% line. And what that means is that on an annualized basis, the NASDAQ 100 almost always moves with greater velocity than the S&P 500. Nothing earth-shattering there. But this point is interesting. This point is interesting, at least to me, when I then see what it accompanies, and we'll talk more about that. So the dynamic that I'm going to keep speaking about here, and that I talked a little bit on the podcast about, was what I highlighted with green circles, the points where the greatest outperformance on the part of the NASDAQ 100, and that inflection point where it ended was typically right around the narrowest point for the volatility spread. And then the reverse is true. when that realized volatility spread widens, NASDAQ 100 tends to underperform. And you can see that highlighted in red fairly distinctly. And what has been happening during this most recent period of relative underperformance is a widening spread. So big picture, what I'm keying in on, and this is not from like a tactical trading standpoint, it's more from like a potential like broader allocation standpoint, is if and when that realized volatility relationship hooks back towards narrowing. I am going to be following that, and I think it could be interesting. Okay. Now, this is sort of distilling or elaborating and taking a big picture view. Visual on the right-hand side here is not showing vol on a rolling basis. It's on a calendar year basis. So what volatility did each index measure realize for each calendar year? This goes back to 2007, as you can see. And I'm curious what jumps out to the audience, but I didn't put some poll in here. You can certainly send it to me if you want to in the chat. And as I mentioned, you likely know intuitively that the NASDAQ 100 tends to move with greater velocity than the S&Ps. Now, again, all the issues with averages aside, they can be instructive. On average, the NASDAQ 100 realizes plus 3.3 vols, long time frame, and we can divert significantly from those averages. Now, breaking that down into per index basis, average vol measure over this long time frame, NASDAQ 100 annualized basis, 21.4% annually versus 18.1 for the S&Ps. That's a 3.3 vol spread. Now, for real sort of mathy wonks, the average deviation in that volatility is wider for the S&Ps, but as the math wonks know, that's typical for lower relative numbers. My takeaway, again, my opinion, is that the vol spread premium typically narrows during times of systemic crisis, 2008, 2020, widens during more idiosyncratic sell-offs, more targeted, like we're seeing now, and then there's been rotations, whether it's globally or into unloved sectors, like we have seen more recently, or like we saw in 2022, okay? The vol spread also tends to widen during prolonged periods of relatively low overall market volatility. So I would be talking about like 2017-18 periods there for those that have been in the markets, for a decade plus. Similar data set, different ways of looking at it. And I think like anything, I think like if you go to an art museum, the angle, or if you're at a music show, a concert, like I go to often, where you sit can kind of influence your take. So here is a visual on the rolling, so it's constantly updating day after day, measure of realized volatility going back to 2020 and the pandemic. NASDAQ 100 in light blue, S&Ps in purple, more contemporaneous. I haven't fully flushed out my thinking in like this more recent past, and I want to avoid that correlation causation overstep, but I'm going to continue to watch, and I mentioned this, that spread between the realized volatility measures and for a point where potentially it's narrowing and narrowing meaningfully. My thesis there, based on this historical tendency, is that if the vol spread continues to widen, I would anticipate continued underperformance on the NASDAQ 100. And then the flip side, if we see that narrow from a broader like allocation standpoint, and I'm not advocating for this, I'm talking about volatility in the relationships, that could be an interesting point for relative performance. Okay, Now, different way of looking at similar measures. Here, we're looking at 1 month, so a shorter time frame, not annualized. Well, I mean, the measure is annualized, but how much volatility has been realized over a 1 month time horizons. I know full well that a lot of Interactive Brokers clients are active market participants, and you may not be particularly interested in the longer term vol measures. You might key in on shorter times like 1 month vols. And just to be clear, this is showing 1 month realized vols, not implied. We'll talk about that shortly. You can see the higher vol levels, again, realized for the NASDAQ 100. And I think that growing realization on the part of option traders is that higher realized volatility isn't inherently a bad thing. And maybe I'm preaching to the choir here, but in this case, that's because it typically translates into higher NDX implied volatility levels, which, depending on your exposure, very much dependent on your exposure, can be a benefit in some cases to vol sellers, in some cases to vol buyers. But a lot of Interactive Brokers clients, I think, understand spreading volatility with complex orders. And in those circumstances, there's certainly no perfect strategy, but more active market participants tend to be drawn to volatility in general from an opportunistic standpoint. And then Andrew and I were also talking at the beginning about like the fact that typically at the single name level for options, the most actively traded symbols don't vary. Like the top 20 looks pretty similar day after day. We're talking about names like NVIDIA or Tesla or Netflix and others. And one way to, potentially gain exposure to all of those in one package or manage a slight dispersion strategy would be index volatility relative to the constituent. That's a bigger trade that continues to grow in the market. And just to be clear, I'm not saying higher or lower vol is better or worse, but I think there are unique opportunities when baseline vols tend to be higher, and it feels like perhaps we're in that type of environment. Okay. Again, it's probably clear already, but all the different angles you can take in like dissecting volatility measures and figuring out what may be interesting. So these are largely related visuals, but this one has a longer time horizon. So in this case, we're looking at NASDAQ 100, 1 month realized vol minus 1 month S&P realized vol. Okay, so that's the relationship. The average spread between the two over the past decade is about 4.5 vol points past decade. Generally, it's vacillated, as you can see on this axis, between like 10 vols wide, significant, and I mean 0 on the low end, and a few points where it was negative, meaning historical vol is lower in the NASDAQ 100. It does happen. Again, think back to this question that triggered all of this thinking on my part and some slide making. I suppose what I want to do is call attention to the very dynamic relationship between index vol levels. And maybe that makes you question some of your default kind of judgments. Maybe it validates them. Maybe it sparks an angle that you want to explore on your own. And those are the kinds of like content, podcasts or shows or webinars that I find most engaging. I know I'm projecting here, but when somebody brings up some data-driven observation that I find interesting, and then it makes me want to look into it more, that's kind of my goal here. I don't want to preach. I just want to point out what I believe to be some interesting volatility dynamics, some of which may be practical on a shorter term basis, some of which could be interpreted on a longer term basis. And that's not always something I focus on. Maybe that's why this was sort of unusually fun to a certain extent for me. Again, related, but just different ways to look at average realized volatility spreads by calendar year. I have pointed out already, I'm just checking time, okay, that 2009 was an outlier year in large part as a function, my opinion, of index construction, where financials are excluded from the NASDAQ 100, and financials were obviously at the epicenter of the global financial crisis. Not the only thing impacted, but they were sort of the nuclear core. In the wake of that crisis, the realized volatility spread was relatively narrow for years. I find that interesting too. And then the relationship changed as the dominant sort of technology narrative really took hold. That point, that the question that sparked all of this, given the maturation, the amount of money, the fact that some of these big tech companies now at different points have been able to issue debt at below treasury rate, like those have become blue chips. And that was part of the question that was posed a month ago. Then I think about like this other 2011 outlier year, maybe. That was somewhat of a crisis-driven year with European sovereign debt at the issue, and then U.S. debt was downgraded for the first time ever, and you see a really narrow spread then. It matters that financials are excluded, and sometimes you underperform. Like over the past 6 months, maybe a little bit longer, financials have outperformed with the interest rate curve kind of normalizing. Then I think about, the relationship narrowed again in 2020. And these are just different ways to see how that ebb and flow moves. And clearly, in the wake of 2020 and the pandemic, that realized volatility relationship has widened. And it was unusually wide in 2022, which, if we go to that to kind of the kickoff here, is what personally I'm afraid of repeating. I'm not necessarily saying I think that's going to happen, but if you think about sort of the overall dynamic, the wind really came out of the sails of large cap tech. And from a market standpoint, it was a much more NASDAQ 100 centric story. The drawdown was more significant, and you see the volatility difference was quite stark 3 years ago. Now, I wonder if this is going to look like it again, or maybe things normalize and that's not the case. But if things normalize, I would expect this spread, which is the widest outside this year, and granted, we're not even a full quarter in yet, would narrow. If it doesn't, I would expect that realized volatility spread to continue to widen. The other dynamic, getting in the weeds here, and I'm trying to realize how much more I hope to cover, but the fact that both realized and implied correlations have been exceptionally low over the past 2 years, in some ways could be driving some of this realized volatility component. That could be a topic for a webinar on its own. Now, much of the stuff that I focus on generally is on the application and potential use cases and risks with index options. For the most part, what I've talked about today is realized volatility. But as option trading listeners know, that's one part of the equation. And there's a relationship, a sometimes strong, sometimes looser one, between realized vol and implied vol levels. Now, what we are looking at is a comparison of the 1 month, the VIX level and the VXN. VXN, the inputs there are NASDAQ 100 index options. The VIX, which is regularly referenced, has S&P 500 index inputs. You see this narrowing here of late. Those points historically have been interesting to me, inflection point. We didn't quite see, like, this was the August 5th date where briefly S&P implied vol was at a premium. So the points where the implied vol spread gets very narrow or negative, I think can be the way I look at the market is that those are arguably capitulation signals. We didn't quite get it, but I am going to keep my eye on that in the future. Here is a different way to look at kind of the same outputs, VXN minus VIX. Now, this one was an outlier print on one of the indices, so that should be thrown away. But this was August of last year. I'm not sure how I'm highlighting it. And that was a signal. And then here, when you get to even, that, I forget which day it was last week, very beginning, like the Monday sell-off, it got very close. Who knows what that means long term, but I pay attention to the relationship between VXN and VIX. And while I'm not advocating, it's something that I think a number of listeners, whether it's now or listen on demand, might be worth putting on their screens and having that as something that you periodically check in on the relationship of. This is like, as I wrap, this is NDX total returns minus S&P 500 total returns, a 10-year look back. Not going to surprise anyone that in the longer term scope, NASDAQ 100 has fairly consistently outperformed. But there are periods of meaningful underperformance. And this one, calendar year 2022, is what this sort of feels like. But then if you figure out an inflection point here, like when that relationship snaps back, I shouldn't say when, I apologize. If and when that big picture relationship moves significantly in one way or the other, my attention is peaked. We have seen that recently. I will continue to track that relationship. Perhaps it's something that you might find useful as well. And not to be a commercial, but when I talk about the power of an index and the group I'm fortunate enough to support, the index options linked to the NASDAQ 100. This, right, was with the early 2000s was a period that I think has colored the perspective, the subjectivity of some people my age and older of the NASDAQ 100. Whereas that question that really triggered this, given the maturation, given the change in makeup, given the change in the world that we live in, and the types of returns and the fairly consistent outperformance that we have seen over the past 2 decades, it's very exciting I just like this visual for a longer term perspective. And again, we are, the NASDAQ 100 is down in the ballpark of 5%, 6% this year. That would be a red number, but we have 3 quarters to go. I have no idea what will come, but I think having some interesting data points, data-driven volatility references can be helpful. And as much of the audience knows, your index exposure can be managed over really discrete timeframes, given the outgrowth of optionality and maturities now. And many end users are really embracing short-dated optionality. I'm not advocating for that, but for those that are adept and informed in those markets, they have been clearly active. I appreciate these opportunities month after month, and I am particularly grateful for the question last month, because that spurred a whole lot of thinking, a considerable amount of output with Interactive Brokers and elsewhere. So Andrew, thank you to you. Thank you to your audience for amazing questions. And I look forward to future opportunities to talk about things that hopefully people find valuable, insightful, and maybe actionable from time to time.
Brilliant. Nice delivery. Thank you very much, Kevin Devitt, at the NASDAQ in Chicago. Questions, please do put the questions into the chat panel. Andrew had a question at the outset. I thought that was a fascinating chart showing the shorter lifespan. I think you explained it very well, but are there other reasons that you wanted to get into about what caused that short lifespan?
I would be open to your take, and granted, it's noisy, right? Because this data moves from as low as an average around like 12 or 13 back up to 25 in the course of less than a decade, and then kind of snaps back in 2016. I mean, maybe this is going to be, I'm not going to carry S&P's water for obvious reasons. But what I could maybe look into is how does this visual compare to NASDAQ 100 constituency and average lifespan? Now, on average, it's going to be much lower because of when the index was introduced just over 40 years ago. And generally, the type of companies that make up the index, the fact that there's only 100 as opposed to 500, but maybe that's going to be a point of future digging for me. See if even the shape over the past 20 years looks similar. I don't have a good answer for you, and I am old enough and ideally mature enough to say when I don't know, and that's the best I can do.
I've got a couple of suggestions. I think
Sure.
Two things: accounting standards and standards, and consolidation and mergers. The former, I think, late 90s, certainly into the NASDAQ, the dot-com bubble, rather. I think there was a lot of, I mean, was it Arthur Anderson went broke?
Yep.
And there was a big scandal at the time as to them and other auditors signing off. WorldCom and so on. Signing off, giving them the, okay in business kind of thumbprint at the bottom of their audits, and they shouldn't have been. So I think there may be a bit of a FASB. Accounting standards did change in 2001. FASB came up, and I think maybe the benchmark was set higher. So, like, what does it take to get into the index might have been a key question at that point. And then all the banks, the massive financial consolidation in the late 90s and probably continued into the 2000s. And I can't account for it 15 onwards down to where it is today.
That is the one. I in my mind have to attribute that to more rapid turnover, that increasingly companies that either have just they're not hanging in long enough. But we've also taught, like, there's been rising tides for localized areas of the market, and like if your average market cap moves up enough, that's going to push out some significant areas of the market and have a significant turnover, and there's just bound to be more in the S&Ps given 500 constituents as opposed to the NASDAQ 100, but I don't have the data right now on the NASDAQ, and so I'm curious how similar or different it looks. And what would be the catalyst for it now to go higher? Just open question.
Yeah, that's a good question. I don't know. I think maybe you're changing in the rules, like they change them less frequently.
Yeah.
Well, one thing I'd be interested to see is starting off at 1965, a point above, every 5 years or whatever it was, that showed so 1965 would be 500. So those are the 500 companies. And then as you go every 5 years, how many of the original 500 companies are left? So what would
yeah.
it be in 1995 and what would it be today? And I think you'll find very, very few
Correct.
of those 65 constituents will be in the index, right?
I can speak on the NASDAQ 100 side. I think the number is 6 from the original Constitution. It's either 5 or 6. I'm pretty sure it's 6. They include like KLA Tencor. Costco is one that has remained in. PACCAR, one that wouldn't typically be thought of as a NASDAQ 100 name, perhaps. Micron, Intel, which has become an interesting stock again recently. God, what am I forgetting? Apple. Oh my gosh, I'm embarrassed now. But that number is only out of the 100. It's 6%.
Yeah, I think you had a couple of slides for that in last month's presentation, which is available for anytime download on the Interactive Brokers Previously Ahead webinars page. What a nice plug there, Kevin.
Thank you.
All right. So let's see. Nareg has a question. Thank you for the presentation. Quick question. If you have, for example, a long-term retirement portfolio where you are using monthly dollar cost averaging to buy ETFs, what would you recommend during these higher volatility and drawdown periods, or AKA correction, switch to a weekly dollar cost average, same monthly investment, or increase your investment contribution to capitalize for the dollar cost averaging? That's a really thoughtful question.
That is a really thoughtful question. It is rife with potholes for me to fall into from a compliance standpoint. What I would say is the fact that you are thinking about that, I tip my cap to you. I cannot and will not be prescriptive, but I would say that that should be a decision that you make with some data behind it. And I think I'm not advocating anywhere in particular, but like that can be why people work with financial advisors. I am not the bigger picture point I took away was, there's this interesting relationship and the direction between volatility measures of these two indices and periods of out and underperformance intrigue me. And that you are taking a step further into how could I potentially on a regular cadence express a view there. I can't answer it, but the fact that you are thinking through that speaks volumes. And I might consider talking to somebody that is licensed and could run some data on what the difference would mean, whether it was weekly, monthly, or more or less active shifting between the ETFs.
All I'd say in response, Kevin, is that whenever I go to the shops and something's on sale, I like to buy it. I always like to buy something when it's cheaper. Rather than
that's the thing. That's the one area of consumer markets that doesn't tend to be the case in capital markets. Is we are generally most excited to buy around highs. If I told you this consumer good is now 13.5% off, the reaction is different than the NASDAQ 100 is now 13.5% off. And I'm not saying it can't be considerably more discounted, but that psychological element of the sale, for lack of a better term, is one that's fascinated me for years.
Yeah. I am a huge fan of how markets work and how investor psychology works. Kevin Davitt, we're up against the buffers here. Thank you very much indeed for joining me. I took the time to write you an email about a potential new webinar and podcast next month, or for next week even, just depending on your thoughts on it. It'll take a little bit of tidying up from you, but check your email, Kevin.
Thank you. And thank you to everybody that tunes in, whether it's live or later. And if you have ideas for me, send them along to indexoptions@nasdaq.com.
Brilliant. Thanks very much, Kevin, and thank you to the audience, and we'll see you next month.
Thank you very much.
Bye for now.